And is this because the companies are so big, it's like just hard to have that net retention at scale? Or do you think that it's because all of the expansion revenue is going to companies like OpenAI and Anthropic?
It's easier to have that expansion revenue at scale. You have more customers to potentially cross-sell and upsell. So this is the number one driver to what I believe is durable revenue growth that goes into a DCF model and gives you that premium valuation. I think they are cautious around what to report now, even if it isn't horrible yet, because they're like, well, what if OpenAI and Anthropic suddenly lean into where we play? Then it could get really bad, and then they're going to ask even more questions. Part of this is, yes, the median and all these quartiles slid by 14 to 15 points. But I think in the back of the heads of a lot of these big companies, they're also saying, let's preemptively make it vague and kind of fuzz it up a bit, because if it does truly go south, at least they're not going to ask for that point from last quarter.
If you were in the shoes of the CFOs of publicly traded companies, like, do you think it's better to just be transparent and, if the business has challenges, like you're upfront about it, but you also are like, we understand it, we've got a plan? Or is it better to just like keep it quiet, try to get people to focus on other metrics?
I was talking to Aurelian Nolf, the CFO of Navan, former VP of FP&A and IR at Lyft. And he was saying at Lyft, we went from like losing $1 billion a year to making $1 billion a year while I was there for 4 years. And there were some very tough quarters along the way. Providing more information allowed investors to underwrite that transition period and feel comfortable with it. And he said, if I didn't give them those data points, as horrible as it was in that moment on that call to actually have to give them and to explain why, that's why investors stuck with them over time and they came out the other side. You create a bigger problem for yourself by taking the short-term way out. If you do plan on being a public company in 5 years, you want to bring those investors along for the ride. I think the best thing to do is to provide more detail and to be very open about what your plan is to improve the number.
I tend to lean towards transparency too. My experience is more on the private company side, but I always would be way more interested in just getting the raw numbers and as opposed to feeling like people were hiding something. Because as soon as someone stops reporting something, or it's like they were bragging about the metric one quarter, a couple quarters later, the metric's nowhere to be found, you just don't feel as confident about the overall business and feel like people are just trying to string you along or tell you a story. They've added AI to their product. They have these AI credit models. They're talking a lot about how much AI consumption there is, but they're not doing the math of like translating that to net retention growth. And so either it's not showing up in terms of like net retention, and so they're not effectively monetizing AI yet, or they will, and so then they're going to report net retention again, but only once it's rebounded.
And that's what'll be interesting if the disclosures start to come back because the numbers are improving. You made the point earlier, Kyle, that the median is not the median if companies are dropping out. And so by my estimation, it's fallen by 14%. I think it's dropped by at least 18% at the median if you were to put many of those companies back.
What do you think is driving this drop? Gross retention is getting worse, so people are churning. It could mean less price expansions if you were able to raise price 5-7% year after year. And now you have to fight for a flat renewal, for example, less cross-sell or upsell of selling more products to a customer. And then there's natural like seat or usage expansion that's kind of just organic as your customers are growing their business. Like if you were to think about what's driving this drop, how would you bucket those?
I would think about it two things because the gross numbers haven't fallen that much. Like ServiceNow still looks impeccable at 98% plus. Same with Workday. I think it's companies with the threat of AI are not able to raise prices as aggressively as they used to. They're calling it a win if they're able to renew at the same amount, which means no increase in net retention. And then I have a theory or a hypothesis that a lot of these companies that have added AI products have experienced success, but it's been a mix shift where they're not consuming as much of their old product as they were before. So they're staying above 100%, but it may be priced differently. It may have went from SaaS to hybrid or usage-based, and it's not showing up in the numbers as a clear win yet. So they're in this transition period.
Fin, formerly known as Intercom. They recently announced that Salesforce is planning to acquire them for like $3 billion, which is pretty awesome for them. But they built a couple hundred million ARR business on SaaS revenue. My guess is that that is falling quarter after quarter as they focus on AI. And they've said their AI business is north of 100 million. Then that kind of begs the question of like, when you do the math of, hey, your customers are spending less on SaaS and more on AI, it probably nets out to above 100 net retention if I had to guess. But like, it's not nearly as high of an expansion as you'd expect, given all that AI spend. A lot of it's trading software for AI.
And think about how much cost you're adding to your model and how much free cash flow you're reinvesting into the infrastructure to provide this. And so it's definitely not as clean as of a story. Not many companies in the public markets, actually none of them, can point to, hey, it's north of 130% other than Palantir, and the investments we're making in AI are directly impacting our net dollar retention rate, which is our measure of customers sticking around, getting value from our product and expanding over time.
Because of how much people are spending on tokens and AI compute, like you'd expect net retention to be pretty good. It's just like that used to be all profits and now it's a pretty high cost basis. And so net retention is actually not that high and we have all these costs. It's a pretty tough combo.
There's a huge impact on valuation. And so I ran a couple different regressions. When I came back up for air, Kyle, what I figured out is basically every 10 percentage points in NDR, so say going from 110 to 120%, is worth approximately one turn of forward EV to NTM revenue multiples. So if you're trading at 5x and you can raise your NDR by 10 points, you can trade at 6x. So that's a huge difference in valuation if you're a company that's growing pretty quickly. And that ratio increases the faster your company is growing.
Let's take a business that is maybe doing 250 million in ARR. What would be their valuation like today? And then if they were to improve NDR, what would it look like?
So if you're 250 million in ARR, you're trading at 8x forward. So let's say you're a $2 billion business in terms of your valuation. If you improve your NDR by 10 percentage points or one turn of your multiple, you're going to re-rate from 8x to 9x forward. Now you're 2.25 billion. So you get 250 million of upside from that 10 points of NDR. And remember, you may actually be growing the exact same amount, but the investors are saying, we're willing to underwrite this to a loftier valuation because you're showing that you've de-risked the model by having these happy customers.
You kind of disagreed with this. You said that, as you're at scale, you have that base of customers. You do want to maybe focus on NDR and, spend a lot more on upselling and cross-selling that base. I just think a lot of the expansion that software companies have seen have been like, hey, we're going to start with a team and then maybe go to a department and then go to a company or maybe go to a division. A lot of the expansion happens within that first year as the company goes from trying a product to that full rollout. But once you've got the full rollout, it just gets harder and harder to sell more stuff or to raise the ceiling on that account. Companies accelerated to full rollout during COVID as their customers were all kind of going through this digital transformation, but then kind of like fully penetrated that base. And then it's gotten way harder to expand customers from there.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run.